All right, guys, here we go. In today's video, we're going to look at the 100-year real estate anomaly of 2008. Are there similarities to today's market? And a lot of financial experts are comparing today's real estate market to 2008. The rate of inflation back then was 3.84%, caused mainly by the huge increase in crude oil pricing. And of course, increasing the CPI, hitting as high as 5%. Also, the average 30-year mortgage rate was around 6%. Now, home prices did fall by 20%. That's because the recession started with the housing collapse, not the other way around. A lot of people think the recession started and that's what caused, the home price to fall, but actually it was the opposite. And also the price to rent ratio was kind of out of hand. And to kind of give you an idea here, 1 to 15 ratio is a buy in that particular housing market. 16 to 20 is probably better off to rent. And then obviously 21 plus in those markets, it's a lot better to rent than to buy. And that is figured by calculating and or dividing the median home price by the median annual rent. Okay. And then problems and issues leading up to the real estate collapse of 2008. Okay. Folks buying homes without the required income to even make the payments. Okay. I mean, that's a big red flag. Low qualifying requirements, standards with very poor industry standards. Okay. That's kind of really what led it on. Exotic loans and loan practices requiring little financial documentation for qualification flooded the loan market. So, what did you expect? Variable interest rates and other high risk mortgage instruments were abundant and easy to qualify for. And then also a note during that period between 2007 2009, an unemployment rate more than double, peaking at 10.8% in October 2009, with over 15 million folks out of work. And currently we're at 3.7 with 6 million unemployed. And then also, if we're going to compare markets, then hey, we need to include the 1980s. Talking about a rough market during the first half of the 1980s, inflation hit as high as 14%, and in the latter half, finally brought down to about 3.5. And as of this recording, we're sitting about 7.11. Interest rates reached their highest point in modern history in October of 1981 when the annual average was 18.63. And currently we're sitting about 7.325. Fixed rates declined but finished the decade around 10%, according to Freddie Mac data. Highest unemployment rate in the 80s was 10.8% that we've already looked at. At the height of the recession in the 80s, houses went down over a 4 to 5 month period, depending on the market location, 10 to 12%. You would figure it'd been a lot more with everything else going on. Then, surprisingly enough, they went back up and ended the recession higher than they were at the beginning of the recession, which is I found very interesting. So, bottom line, all that matters is growth and inflation. Okay, the Fed can try and curb inflation, but it goes up every year. By the printing of new money, et cetera, et cetera. Their goal is always try to get us back into the 3% range, 3.5. So basically, the Fed is saying that the value of your asset, if you buy it right and you have the right type of asset, should be going up year over year. And then typically, and this is very important, typically in an economic turndown, recession, crash, whatever you want to call it, lasts approximately 10 months. Now, the Great Recession of 2007 through 2009, of course, that lasted 18 months. Unemployment rate took 6 years to return to pre-recession levels and 8 years for the median household income to recover. That's why it was so bad. And then, we also got to look at the positives, okay? Compared to the 80s and 2007 through 2008, Homeowners on average have 185,000 in home equity. Now, obviously, as prices come down on homes, that, equity is also going to come down as well. And then also, those that have pulled some out to, I don't know, pay for college, their kids' college or whatever, that would also cause it to, lower. Now, this is interesting. Credit scores on new home purchases currently supposedly are all-time highs. In other words, people are paying their bills, are coming in strong. And then also very few of these crazy adjustable rate mortgages and other exotic, risky financing is not being heavily used, at least at this time. However, if reading up on it, more and more home builders are accelerating their incentives at this time to buy homes. Of course, we're going into a normal low season anyway, starting, October, November, December, even into January, February is normally a low season anyway for the real estate market. But these guys have, I'm not going to say overbuilt, but maybe in some areas they have, and they're wanting to get rid of that excess, supply. So they're, putting in all kinds of incentives for people to come in and buy those homes up. And, hey, just ask any loan originator. The Fed, over the last number of years, especially since 2008, has added a tremendous amount of underwriting restrictions, making it more difficult, for the loan process itself, as well as qualifying requirements, which is very important. You want stronger, people in there that can hopefully stay there and pay their bills, pay their mortgage company. Now, the part that I like best, let's go to the charts and try and pinpoint the bottom and start a recovery for the real estate market. All right, guys, we're going to take a look at a couple of charts here. The two that I like to watch and take note of regarding real estate is both the home sector, retail, uh, the I guess what I'm trying to say is, basic uh, home builders and companies that have to do with home building, home improvement, that sort of thing. So, what we're going to look at first is the spider for the home builders, the ETF, and XHB. And as you can see here, regarding the pullback that we had when this market started coming back in, and then we'll look at the commercial side of it. But right here, XHB, the top the top holdings, DR Horton, Johnson and Controls, Lennar, Home Depot, Pulte, Builders First Source, Train, and Carrier. Okay, kind of a good little basket there of you know, uh, of companies that are really involved, in home building and taking care of the, retail home buyer out there. But anyways, you see here we have this uptrend line, which is very key. Most times on the third hit, you'll get a, bounce, and then on the fourth or fifth, that'll collapse. So yeah, they let you know a little bit of, ahead of time that prices were, soon to pull back. And then here you go. And the perfect storm was this weekly candle right here at the blue arrow when it closed under the up trend line and then also under the 20, which is very important. And then we put in what I like to call this. Let me just go ahead and take this out this W formation, which is really beginning to turn into, an M formation. It looks like here, potentially coming back. And why do we say that? Well, right now we're in this, I have it kind of highlighted here, this sideways consolidation zone. And the reason why price consolidates, one, is either accumulation. The big boys are, big money is sitting here accumulating, anticipating a push to the upside or breakout to the upside, or it's distribution, where they're selling off slowly, anticipating a pullback or breakdown to the downside. So I'll let you be, determine that for yourself, which way this thing is going to break. but kind of give you a hint about it. This big sell-off candle, that ended last week. This is this week's candle, red candle there, still above the 20, still a little, bullish in that area, but still we're anticipating, lower lows as you see. That's what we've been putting in, lower low, all the way through here. So there's two ways, that a market will trend. It'll uh, trend in our M formation, where you make a high, lower high, and then you take out that previous low pivot, and you're definitely, going to the downside. And then, of course, the W, where you come down here and you're putting in higher lows. And then when you take out that previous uh, higher high, then normally you get continuation back up to the upside there. Okay. And like we were pointing out earlier, yeah, we're expecting, this to come in like that is, so we have a low, higher low. Looks like we're going to take off, but we can't take out this previous high. We make a lower high, and then kind of the nail in the coffin is when you take out this higher low in this area. Depending on what asset you're looking at, it's all going to be a little different far as the range, the time, but basically the same formation will come out. Now, what everybody's waiting for, where do we anticipate the bottom? Well, there's only three main areas that an asset will find support and potentially bottom out. Now, there's some other, variables, other factors, of course, with real estate. Normally, real estate is the last to bottom and consolidate and then start, pulling back up to the upside. Okay. Normally, stocks actually hit bottom, pivot, consolidate, and start moving up, and then real estate's generally the last, sector to make that move. And actually, as you can see here, let's just use COVID as a example. We had pretty much a V-shaped recovery. Okay, let me make that a little clearer for you. And then the other recovery that you can have is a W-shaped recovery. Again, where you have put in a low, a higher low, and then you take out that higher high. Then price generally by that time does have time to work its way up and then have more velocity, more acceleration to the upside. Okay. And then the other way, there's kind of a couple of variations of it. Price will go down, or an asset will go down, and then it'll take a while to move sideways or trade, sideways away from this big pullback. Like if we went over here, let me take all that off, clean this up. Like if we came down, instead of doing a V, we came far and away from this downtrend over here, and then we start putting in our W's. And sometimes even a variation of that, you'll put in a fry pan bottom, and then when you break, the top of it, that's when price explodes to the upside. So bottom line, where do we see price on this thing? Well, like I was saying, that's what we're going to be looking for. We're going to be looking at those different formations, the V shape, the W pattern, and that will, determine how, when, where, and how we'll be able to pick, not, the exact price of the bottom. Now, there's a couple other ways you can do it, where you'll have potential pullback, a potential move to the upside, and that is find a higher low pivot area on the chart that was previous, support or resistance that could now be, again, support for the asset, including, a moving average, a fib line. Now, just one of those is not necessarily going to help you, but if you have a combination of those three, two or more, then you have an 83 to 87% probability that price will, settle down in that area and, consolidate and then push to the upside. But the home builders, is one basket we look at. The other one that we like looking at is the commercial side of it. Okay. And then I'll draw this even on the commercial side, you can draw this out and see, your trend line there, and then the hit, the three hits, and then how we broke down this big weekly candle here and under the 20. Now it came close to coming back up to it, but here we are now. So that little push here didn't really help a lot. Plus, basically, you could not get back up and over and start consolidating, above the 20. So that's going to be a key factor here going forward with the commercial side. And this company here recently bought out Duke Realty. You can look them up. They were one of the biggest in the world, and mainly they owned hundreds of thousands of square feet of warehouse space. Some of their big customers are Amazon and FedEx, as you can imagine. And as Amazon and FedEx pulls back, as people stop spending as much, you could see, that unneeded warehouse space could be closed down, and these guys could, start losing money quarter over quarter, and then obviously price is going to come down, with that. So, and again, here we are kind of in this consolidation zone. And again, do you think they're consolidating, accumulating for a potential push to the upside? Or do you think big money is selling here and expecting a push to the downside? Okay. So that's, yeah, I think you got that figured out. And again, we're going to be looking for those high and low pivot areas as price comes down, like this area here. See if we get a good if we get a pullback to this $68 area because of all this consolidation in this area, and how we pull back and then got right back in the game uh, through this period of time. And that's 18 2000, really 2017 through into 2019. So pretty good area here of accumulation. And then going back to it, we'll look for that, V, or preferably the W. It really is the strongest of the two as far as reliability and credibility, as far as, holding price and in that anticipation of higher highs. So, guys, I appreciate you watching. Give us a follow on Twitter. Check out our Patreon, and we will see you on the charts.